Muy bien. This
Okay.
is very exciting. Yeah, we're live. And we are live on YouTube and Instagram right now. Um, Very excited for this conversation. We have Ryan Delaney here with us and Edwin. We're going to be having a very, conversation about the coffee market. Everyone's talking about the market. Prices are hitting historic highs. There's a lot of volatility. Some people might be navigating through this uncertainty, and that's why we're here to talk a little bit about what's going on and hopefully bring some clarity. Um, Ryan, why don't you give us a little bit of your background for those who haven't heard much from you?
Well, actually, I'll jump in and make an introduction. Thank you. Thank you much, Oscar. Hi, everyone. Thanks for joining us today. We're so excited to have Ryan Delaney to help us make sense of what's going on in the coffee market. Prices, as Oscar mentioned, are hitting some historic highs, not counting for inflation. Um, and there's an incredible amount of uncertainty on how to navigate this. And so we just felt it would be valuable for our audience to have some insights that they may perhaps not have as much access to help make sense of some of this. So Ryan is someone that we have really enjoyed leaning into for deeper understanding on a lot of things that we don't understand. As a background, I'm just looking here at some of your background, Ryan, a BA in government from Harvard. You're in the U.S. Marine Corps, and maybe you might share some stories of what's on the wall behind you there. You served in Iraq and Afghanistan. So thank you for your service. And you've worked as a trader and also as an advisor, a relationship manager, and have a lot of experience hedging. And want to make sure to provide opportunity, not just now, but at the end, to let people know where they can find you, as you're the founder of the Coffee Trading Academy. So, Ryan, thank you for joining us, and if you would, feel free to fill in any gaps there, and to share about yourself, and we can kick this off and have some interesting dialogue.
Cool. Yeah. No, thanks, Edwin. I appreciate you inviting me. We've known each other for a little while now, and it's good to have these conversations and keep the discussion going. I always become more popular when the market becomes over $3 or unpopular, I guess, depending on which side of the market you're on here. So there is a lot going on. It is a pretty intense market right now. I guess I'm somewhat of an academic these days with the Coffee Trading Academy. So I'll try to help us understand it. But honestly, everyone's trying to figure it out. It's why I call myself, even though I run an academy, I'd say that, my logo is a ninja, right? And I used to, that came from a joke I made a few years ago. Where I said I was a coffee price risk ninja. But the truth is I'm really more of a student of coffee. I'm not a ninja by any sense. And that's something that I try to offer people as the result of studying the market. So that's something we can talk about today. But thanks to you both. I was telling Oscar earlier that he looks like the patron saint of coffee there with his halo flavor wheel behind his head.
Heavenly.
Yes, exactly. It's because of all of the beautiful heavenly coffees you guys are selling these days.
Well, maybe we can, I guess, what I'd like to cover in this time, just for any of you who are watching this now live or recorded, at a high level, if we could start, Ryan, with number one, keeping in mind a lot of our audience is small to mid-sized roasters. I would say most of which are not buying coffees on a differential. And our model has been very direct with producers, aimed and birthed with a very fixed price concept. As we've seen through the pandemic, and now again, cost of labor went up for us 53%. I was talking to last year from the year before, and I talked to someone in Nicaragua yesterday, and their labor is double to triple this year from last year. We didn't have an increase this year, but they had a massive increase this year. And as we all know, labor is going to be a number one cost on inputs. So I share this just because the context is we've been through a journey where our aim is to be working closely with small and mid-sized producers. And as we've grown, we can't ignore the market. And as much as we want to decommoditize, we want to be honest with farmers and roasters that volatility is often impacting one or the other. And as we're trying to create a stable conduit and build predictability, extreme volatility impacts us all. And so I think some of our customers have, because they're small and because they've worked with companies like us, have largely been insulated from volatility.
Mm-hmm.
And that's not the case anymore. So I don't want to be an alarmist or cause unnecessary panic, but I also don't want people to not be proactive in terms of recognizing where we're at and where we could go. And so before talking about where we're at and where we could go, if you could maybe take a few minutes of where we've come from in terms of the market to get to where we are today, and then share about just high level where we're at today, and then we can talk about where you see things could go. And this was all I just want to share with everyone listening to. This was triggered by, we're aiming to do some live interviews regularly on Fridays, not every Friday, one a month or two. And you had posted on LinkedIn, Ryan, a comment about a nightmare scenario. And that got me thinking. And so I want to make sure that we touch on that later. And so if I forget, remind me. I want you to loop in a little bit of what's happened with cacao, because sometimes we can learn about what's possible by looking at other industries that share some similarities. So
Sure.
I want to just give you space to flow with this as you wish. But yeah, where have we come from, and where are we now, and where do you see things going?
Okay, yeah, thanks for that, Edwin. So we got a few different things we can talk on here. So I think what might be helpful is we can talk about, who your clients are and their business. We can talk about, a little bit about my background and experience in the market, and then we can also talk a little bit about where the market is and where it's going, and how the three of those things intertwine and are relevant. So I think who your customer is, if I'm not mistaken, tend to be what we call small to mid-sized roasters, meaning that they're not, the mega corporations of the world. They're not, necessarily multinational. Some of them might be, but maybe they've got a few different coffee shops, or they sell locally to retail, to supermarket chains and local cafes and stuff. Maybe they're doing a few different containers of coffee per year. Okay, so if that's your core business as a roaster, what you are probably focused on is your relationships with your clients and the quality of your product. That's probably your two main focuses. Whether it's direct, people walking into your coffee shop and you have a relationship with them personally on what kind of coffees they like, or whether it's, a bit more removed with you're selling to, owners of coffee shops, and you're selling to cafes or chains or supermarkets. Okay.
Yeah.
So from that perspective, the roaster needs the green coffee to come in as an input, and then they're going to make their blends and they're going to distribute that as an output, right? The finished product. And most of the roasters that I know, while they're smart people, they're not necessarily interested in, I want to be an economist or an analyst and study the nuances of commodity markets. And maybe that even offends them to some degree, right? They're craftsmen or artists, right? They want to produce this product. But at the same time, if they're going to run a business and they're going to be profitable and sustainable, they have to turn that profit. And that comes with a fundamental challenge. And that challenge is that they tend to have a relatively stable sales price. You know, when you walk into a coffee shop, you can't have a little, you know, electronic ticker like in the stock market with your price changing every day.
Right.
You know, it's got to, your customers demand some kind of stability. So
It's not lobster. It's not market prices.
It's not market price, although it might move that way, right?
Yeah.
So on the one hand, we have a stable sales price, but we have a volatile purchase price, and that disconnect is a real challenge for roasters. And so the roaster does not necessarily want to know or care about the global price of coffee, but they need to have an intelligent plan in place so that they can build in their margins and be sustainable. Now, my background is I started out trading physical coffee, both certified and specialty coffees, in the U.S. And also in India and Uganda, buying coffees, processing them, and exporting them to clients. And then I also worked as a hedge fund analyst and trader. So I worked for a multinational coffee company that had a coffee, cotton, cocoa, and sugar hedge fund. And so that was where I got my exposure to the global futures market of coffee, okay, and the other commodities, how to analyze that market, try to predict prices, and understand how that price is moving and what are the dynamics at play there globally. And then from there, I transitioned to a role where I was on the sales side, meaning I was working kind of like a financial advisor for roasters, producers, and the trade on how to think about price risk in the coffee market and how to manage that risk. So that's my background. So where we're connecting here, obviously, is that your roasters don't necessarily want to focus on the global price of coffee, but they have a need, which is to understand the global price of coffee. And that's kind of my expertise, is where I advise people on that. Okay. So what is coffee price risk? I teach a course, a 5-day course called the Coffee Traders course. And in that course, we've had some Onyx clients there as well. And in that course, it's all about how to manage coffee price risk. And coffee price risk is the fact that the price of coffee is volatile. A few years ago, it was at $1 per pound. Now it's above $3 a pound, right? So that's a 300% increase in just a few years, right? So that if you have as a need to purchase coffee for your sales, then that is a risk. That's a major risk for your business. So that's coffee price risk, and we can manage that price risk through different strategies. Now, that's particularly relevant to us today because, as you mentioned, Edwin, in the intro here, prices have been very volatile. They have been moving a lot, and there's a lot of uncertainty about what is going to happen with prices in the future. So I can talk a bit about what the current situation is, but maybe it would be relevant to talk about what the futures market is for just a minute here. So we'll take a little segue into what is the futures market.
Let's take that segue.
Okay, because I think maybe your clients do not they're certainly not trading futures, right?
That's correct. And so I really appreciate everything you're sharing and how you're sharing it, because our aim is to inform,
Hmm.
educate, and equip with understanding and tools so that we can do everything within our power to increase and begin to build a little bit more predictability.
Right.
So yes, take us on a future
And
segue.
predictability is certainly a challenge here.
Yeah.
And that's actually a good segue into our discussion of the futures market here. So if you're a roaster listening to this and you're saying, I don't care about futures, I care about coffee,
Right.
and buying and selling coffee for my business. Unfortunately, you are connected to the futures market. Right? I mean, it's not necessarily unfortunately or fortunately; it just is what it is.
It's a reality.
Right. And some people get very angry at the futures market. The futures market is not something we need to feel bad or good about. It's actually forms a very useful function. So all the futures market is it's a standardized market for forward contracts. Okay. So your clients are trading forward contracts. So if you are and spot contracts. So a spot contract means I'm buying coffee right now, and it's changing hands on the spot. A forward contract is where you are saying, I want to buy coffee to be delivered to me at some point forward in time, right? So in a month or in 6 months or whatever. So what the futures market is the market for standardized forward contracts. So all it does is it says, hey, we're going to take, instead of saying, oh, I want to buy a Colombian Excelso at this price, it says I'm going to buy a generic coffee at this price. And that's what the futures market is. So whereas if I have a bilateral agreement, if I'm contracting with Edwin, and if I'm a roaster and I'm buying from you guys, and I say, okay, I'm going to buy my Colombian Supremo at plus 20 or whatever, or at a flat price. Maybe I book that at 350 cents per pound from Edwin to be delivered in 2 months, right? So that would be February. So let's make it 3 months. We'll make it March.
Yeah.
The futures market has March contracts, May contracts, July contracts, September contracts, and December contracts. So they're just standardized forward contracts. Now, why that matters to you as a roaster is that is the benchmark, that futures market, by which all coffees are priced. Mm-hmm. So because that futures market is a generic coffee, whenever we talk about a specific coffee, we are saying it is in relation to the generic, okay? So that's where we have our differentially priced contracts. So if I'm buying a Colombian coffee, then I might say it's plus 20, which means that it is whatever the generic price of coffee is plus 20 cents. Okay, so Ryan, what does that have to do with the nightmare scenario and where we are with coffee now? Well, the futures market is in a historic rally at present. So the market has rallied to levels that have never before been traded on the Arabica market in non-inflation adjusted terms, so in outright dollars. Okay. Mm-hmm. So that the previous high, I think, was in 1977, and we passed that just a few days ago. Okay. So how did we get there? Why did the market rally so much? Basically, the underlying dynamic or cause of the futures price is global supply and demand. There are some other things that influence it, but that is the primary factor. So supply and demand has an inverse relationship with price. Okay. So in other words, when supply is very low, then prices are high. When supply is very high, then prices are low. And that is, again, not a good or a bad thing. It is just how people react to supply, right? If there is abundance, then that thing becomes cheap. If there is scarcity, then that thing becomes expensive. And that's how we are regulating the supply. So if you look at any commodity market in the world, gold, energy, coffee, cotton, whatever, in general, that will have a very static range if you're looking at like a 50-year long-term horizon. And
Right.
that dynamic range is because of this balancing that the scarcity and abundance dynamic has on prices. Okay. So prices become very high, and then we consume less because there's scarcity, right? So that regulates the consumption. When we regulate our consumption, we were consuming less, and the producers are incentivized to produce more. So supply rises and then prices fall until they fall too much. And then the producer is disincentivized to produce coffee, and the consumer is incentivized to consume because it's cheap. And then that raises prices. So that's why if you look at any commodity market, we have this very static range that the market tends to trade in. Right now, we have just busted above the top of that 50-year range, which is very unusual. And it's typically that signals the end of a bull market. So that would mean that we have reached the high and the market is now going to come back down to the lows. However, in rare cases, and this is what we call the nightmare scenario, that does not happen. We hit some dynamic of extreme scarcity, and prices have to react in an extreme way. What makes this more potentially scary for a consumer is that prices are parabolic. They are not linear. So what does that mean? It's not like if supply goes down by 1%, then prices rise by 1%.
Right.
Prices will have the supply will have very little impact on price when prices are abundant, right? So if we have, if you think about a warehouse somewhere, right, and that warehouse is full of coffee, if the warehouse goes from 100% down to 98%, the market does not care. It fell 2%, but it's still functionally full.
It's still working.
Whereas if the warehouse is at 5% warehouse levels and it falls by 3%, that's still a 2% decrease. But it is much scarier to fall from 5% stocks down to 3% than to fall from 100% down to 98%. So the market will react in a much more severe way to that tiny decrease in stock levels in an extremely scarce market than they will in an extremely abundant market. So we are in a situation now where the market thinks we are at that 5% inventory levels. And any small reduction in the existing inventory is going to have an extreme reaction to price. So that's the situation we're in now. And that also is why it is so important to think about and prepare for the future, because if we get any additional reductions now, that can have a dramatic continuation of the rally in the future. But this is where it becomes very difficult. There's no perfect insight into the future. There's no crystal ball where we can say with any kind of certainty whether the market's going to go up or down. And to make matters worse, when we get we have the train adding to the drama of this.
Yes, sorry about that. It's a good time for that drama, though.
Yes, it's the visualization of the coffee market, barreling towards $4 here. But I forgot what I was talking about. What was I talking about?
You were talking about, you had just explained the difference between dropping 2% if the warehouse is full versus empty. And so we're at a unique space where we don't have a crystal ball. I think you're about to pivot into
the predictability, right? And that was what you were asking about in the beginning, is the predictability of prices. And unfortunately, we don't have a crystal ball where we can predict with certainty what the market is going to do. And at this moment in time, there is an extreme amount of volatility. So if we had perfect visibility into what supply actually is at any given moment, then the market could price perfectly based on that visibility. But we don't have perfect visibility. Coffee is notoriously opaque. So one large segment of the people who are involved in the coffee market, the traders and whatever, might be very, very bullish the price. They think there's very, very low inventory. And one other group might feel like they are bearish. They might feel like, no, the bulls are mistaken in their view. And so we have this push and pull between these different traders who either are trading speculatively or trading commercially the coffee. And they're really kind of both the same thing, but we can talk about that later. And that's kind of the situation where we're in right now. So what remains, the question that remains is what's going to happen in the future? And as a roaster, how do I prepare myself for that?
And I appreciate that. And I guess I probably should have opened with this, that we want to be thoughtful and clear that that we at Onyx or you aren't saying a roaster should or shouldn't do something, but to have information. And because I've never experienced this before, I think it's hard to, there isn't a playbook, but the two extremes that come to mind that I think a lot of people will default to is one, to have a strategy of hope. And I feel that's largely what someone with less information might do, and say, okay, well, let's look at history. Every time it's gone up close to this, it hasn't held there for very long, and what goes up must come down. So let's just hold our breath. Well, people have been saying and doing that as we have a cumulative shortage, and the inventories of physical product seems to be less and less, and people generally are, people meaning roasters, importers, have forward contracted, just in reading different articles and data points, it seems about half of what they normally would at this point. And so people aren't long. And as time passes, the urgency for anyone buying goes up. And I think that's part of what contributes to this, a 2% drop when you're at 5% full in the warehouse versus at 50 or 90%, has a much bigger impact. And if that's a legitimate shortage, then I think the nightmare scenario is that not only that it goes up higher, but that it holds for longer than what we might expect if we look at history to predict the future. Is that correct?
Yeah, I mean, I think that's a pretty good summary, Edwin. And you know, it all comes down to, at this point, to what the commercial is going to do. And there's a report that comes out in all the commodity markets called the COT report, or the Commitment to Traders report. And this report spells out explicitly who are the traders in the market and divides them into categories. Okay. And in particular, commercial users. So that's producers, merchants, and processors, and speculative traders, right? Mm-hmm. Basically hedge funds. And this dynamic of hedge funds and commercials is a symbiotic relationship. Yeah, everyone likes to hate the speculator, right? And you know, it's fun to hate them, right? They're a hateable group, right?
They are.
And you know, and I say that as someone who used to be one, right? But The truth is that they are very important to the market and they're necessary. And
Mhm.
the reason that the speculator is important is because the speculator enables the producers to sell high and the roasters to buy low. Because if there was no speculator in the market, then the roaster and the producer would have to trade directly.
Mhm.
And the way that it works now with the futures market is that when prices are low, the roaster will buy futures, right? And at the same time that they are buying futures, the speculator is selling them those futures. They are the one that's selling the futures because the speculator tends to be a trend follower. So as prices fall, the speculators sell more and more and more because they think they're going to continue falling. And the roaster tends to buy more and more and more as as prices fall because they see that prices are cheap. And then the opposite is also true. When prices are rising, then the roaster is not buying. And that's what's happening now. Prices are rising, and the speculator is buying more and more and more because they think prices are going to continue to rise. And the exporter or farmer is selling more and more and more because they're getting better and better prices. They're selling more and more, and the buyer is the speculator. So normally that works quite well, and in actuality, a lot of hedge funds lose money, and the beneficiary of them losing money is the roaster and the producer. And some do well. Obviously, you don't last very long as a hedge fund if you don't do well. But the hedge fund makes money when when they start buying and prices continue to rise, right? And when prices are falling, right? The roaster makes money by buying at the bottom of the market, and then the farmer or seller makes money by selling at the top, right? And so you need all three of these players to make this work. So if we took the speculator out, then the roasters and the producers would both have to be buying at the middle instead of buying at the top and selling, buying at the bottom and selling at the top. Now, the problem now, and what we call the nightmare scenario, is the speculator bought from the bottom all the way to the top where we are now. And normally what would happen is that because prices are high now, it would disincentivize consumption, it would incentivize production, and then prices would fall. The speculator would have to get out, and then the roaster would be able to buy their coffee as prices are falling. That's the normal way, and that's the way that the market works 90x% of the time. What the nightmare scenario is, and what happened in the cocoa market, is the prices went up. The speculator became fully long. They became engorged on cocoa. And instead of the market falling, the roasters or consumers in that market decided that actually the situation was not going to improve. They had another disaster on top of their previous disasters. And so the consumer had to buy from the speculator. And so the last leg of the market had this very unusual situation where the speculator is actually dropping their position as the prices rise, which is almost unheard of in any market. And so the consumers got extremely long and pushed that market from the historic high. So the cocoa market normally trades between, say, $2,000 and $4,000 per metric ton. And it rallied, that process started at $4,000 a metric ton. And then it rallied all the way to nearly $12,000 a metric ton.
So it effectively tripled from the high point.
Exactly. So the nightmare scenario for coffee would be that now coffee triples from the current situation. Now, I want to be absolutely clear. I'm not predicting that. I'm not saying that is what is going to happen. I don't even think that is likely to happen. But that would be the worst case scenario for consumers. The more likely scenario, I think, would be you get some small version of that. Normally, you'll get the roasters do what what's called capitulation, where they buy some amount that will get them by, right? They buy just enough to say, okay, I can 6 months or whatever. And then the market rallies a little bit as they capitulate. And then that normal dynamic happens again. So that is what I think is more likely. So I think there's two things we can kind of close with here, two topics, which is number one, what's going to happen in the future, and I think and two, how can the roaster best prepare for that?
Yeah.
So what's going to happen in the future is very difficult to say, because in coffee, I often tell people there's no truth in coffee, right? In scare quotes, because there is no like universal data source that says this is what the supply of coffee is.
Mm-hmm.
In a lot of US based commodity markets, we have the USDA report. The US Department of Agriculture will publish a report saying this is what, the cotton supply and demand is. And because that's a US based contract, the USDA report is taken pretty much as gospel. People generally say like that's what supply and demand is in cotton. Okay. You might deviate from that a little bit. You might say, no, we're more bullish than the USDA, or we're a little bit more bearish than the USDA. But there's no equivalent in coffee. The USDA does actually publish a coffee report, but it's not market moving. It's not generally considered to be reality. Okay. They don't have the same insight into that market. And so we don't have there's no central idea of like what is supply and demand. Instead, we have competing views of supply and demand. So one market segment might think the supply and demand is this, another market segment might think supply and demand is that, and a third segment might think it's something different. And in the end, the only truth that we have as such is the price, and the price kind of determines who is correct. Now, behind the scenes, ultimately the supply and demand will play out, and that will be how the price is discovered, because it's just a matter of how many buyers are buying and how many sellers are selling. So we know that happens, but the problem is that can happen on different time frames, and it can happen, for different reasons, right? The price could rally, and you might think, oh, I'm correct, but actually the price rallied for a different reason than what you thought.
Right.
So that's a little bit of a dire picture for understanding the coffee market. But what we can do is we can at least have a methodical way of looking at the market. And that's what we try to do for our clients, is we say, we are going to have a consistent methodology for how we look at the different components that contribute to price discovery. And therefore, we will use the same analysis on that to give you a view on what we think is going to happen with prices. And long story short, I would say that the market appears to be either in the ending late stages or the middle stages of a bull market. And that's a big difference, unfortunately, right? Which part of the market we are in makes a big difference for prices. And I would like to just say, oh, I'm bullish or I'm bearish, and therefore you should do this or Y. I wish that I could say that to people, but it's not an honest answer. Now, people in coffee have very strong feelings, and you'll get a lot of people who will say, I'm definitely this, the coffee market's going to do that, and will be absolutely certain about it. Some of them are good at their predictions, and some of them are not. But that's my view on where we are in the market. But regardless of whether we go up or we go down, it's important that the roaster has a plan for how to deal with that, right? And the old saying goes, the best time to plant a fruit tree is 10 years ago. The second best time is today, right? So it would have been a lot better if you were a roaster and you already had a plan in place, and now you're able to react according to how you've planned. But if you didn't, then the second best thing you can do is to make a plan now. So there's a few different ways that you can do this. My general strategy that I advise my clients to use is what I call the rule of thirds, okay, or systematic hedging. And what that means is you take your needs, your physical coffee needs. I need to buy, 100,000 pounds of coffee per year or whatever it is. You divide that into 3 buckets, and you say 1/3 of that needs I am just going to buy at an average price of the market, right? What you mentioned as dollar cost averaging. I think maybe you would advise some of your clients to do dollar cost averaging. So that's a perfectly reasonable strategy. If you dollar cost average, or in other words, if you average your buying out over time, you will never do better or worse than the market. And that is the baseline. That's your baseline for whether or not you're doing a good job on your buying. Okay. So if you're buying below the market, then you're doing a bit better, right? And if you're buying above the market, then you're not doing such a great job. Okay. So the baseline is the average price of the market. So you can dilute your risk by averaging your purchases. And I've got a good friend who's a major roaster, and he tells me, he always says, Ryan, I strive to be average, right?
Yes.
Goals. And all he means is that he's not a hedge fund trader. He's a roaster, right? All he wants to do is just average out that price. Okay. And if you were to do that, it will add some stability to your portfolio, to your coffee buying, right? So yes, buying at 3.30 cents per pound is not fun when the price was at 2.50 cents per pound just a few months ago, right? But if you had been buying at 2.50, then you buy some at 2.70, then you buy some at 3.30, that's also not as painful than if the market rallies to $4, right? And if the market falls down to $2, then you buy some more at $2. And now it's not as painful than if you had bought all of it at $3, right? So a dollar cost averaging strategy is a very good practical way that you can dilute your risk, okay? So that's 1/3 of your buying needs. And then another third of your buying needs is going to be what I would call protective, okay? So that means you are instituting strategies that are going to protect you if the market rallies. The last third of your needs is going to be what I would call, say, opportunistic, right? Or conditional. That means that you think if you're a consumer of coffee, you're going to buy below the market. Maybe you say, I'm going to hold off on some of my buying because I think the market's going to fall a few cents here. So you're going to buy a little bit below the market. Now, there's risks to all 3 of those strategies, right? If you're averaging the market, then the risk is that if you had just been more patient, you could have bought cheaper. If you're using a protective strategy, right? So, for example, if you are very scared that the market is going to rally, that the market is going to continue rising, you could just buy all of your coffee right now. In fact, if you were certain that the market was going to go to $4, that would be your best strategy. Would just be buy it all right now, because then you'd be better off than if you'd waited. And in the third strategy, if you wait to buy, of course, you can get in trouble if the market then rallies, right? If you never get to that lower price level you were waiting for. So all 3 of these has risks. Now, what you do is you divide your buying into these 3 strategies. I'm going to do all 3 of these strategies, but what you change is the distribution. So if you have absolutely no idea what the price of coffee is going to do, you are not confident in your ability to predict the price, you just need to do something and you're scared and you need a strategy, then just do all of it in dollar cost averaging. Just do shift it to 100% average price. Yeah. But if you have a view on the market, and I would encourage all of your clients to have a view on whether they're bullish or whether they're bearish,
Mhm.
then you're going to adjust your strategies to account for that. So if you are bullish, if you're fearful that prices are going to rise, then you're going to have a higher distribution in your protective strategies, right?
Right.
So maybe you might say, look, I'm worried right now that the prices are going to rally. So my main concern is protecting the upside price risk. So you'll say, okay, I'm going to continue my dollar cost averaging strategy for maybe 50% of my buying, but another 40% of it, I'm gonna just increase my exposure now. I'm gonna buy some more coffee, so I'm protected if the market rallies. And only 10%, only a small amount, am I gonna play the game of trying to guess where the market's gonna go and try to be more proactive in my buying. So if you're trading physical coffees, those are the three basic strategies I would use. And your main concern is going to be, how do I adjust those dials? How do I adjust the weighting into which one of those strategies? Yeah, so I think that's the main strategy. And then the concern at that point is, how do I build my view on the market? How do I think about where the market's going to go?
Wow, this is, I've had so many questions, and just by biting my tongue, you've then gone on to clarify and answer one right after another.
Okay.
Thank you so much. This is incredibly helpful and enlightening. I think a lot of our customers are in a space where I think there is a lot of discomfort with the uncertainty, and there's a natural desire to have more predictability. And I think in terms where there's more volatility, I mean, anytime there's a problem or a challenge or a hardship, it's also an opportunity. And so I think this is an opportunity for sharpening habits on how we do business, in terms of being able to control a little bit more what we can control, which isn't a lot, but I think to not be more intentional, and as you said, to not have a view, means that one is just completely taking a gamble. And oftentimes the reactions that I see and what I'm hearing and talking to people are, first, the sense of fear and caution and deer in headlights. And I don't know, as a Marine, I don't know if you train to hold your breath and you practice and practice, a human can hold their breath for a long time. And I think roasters largely are in this space where, okay, I really need to practice. I thought I was holding my breath for a while, but I need to hold it for longer to get through this. And I just feel it's a bad strategy to do nothing.
Right.
And it's a bad strategy to be reactive and try and solve and control everything. And so having a strategy that recognizes what one can and can't control, and to begin doing something that can begin building some predictability is incredibly valuable. And it's not until one's looking back that you realize that can be very helpful, or perhaps regret for not doing it. And then a lot of this, I think, comes down to people's risk tolerance, and separate from a personal risk tolerance, what the risk tolerance of a business. Because one could say, as a strategy, well, should I raise, as a roaster, my prices, if my prices are increasing by 60 to $1.20 a pound green, should I raise my roasted prices by $1 or $2 today? Do I wait a month or two, or I'm just going to wait this out, and by spring of 2026, hopefully this will all be over, so I can calculate what my loss is going to be if I don't make any increase in price. And so I think playing through these different extremes is helpful to then figure out, okay, do I really feel comfortable with that? And the concern I think that many roasters have is, I feel I need to raise prices, but I don't want to lose customers.
Right.
And I believe that we're going to see the larger companies, I'm talking about the largest companies, making increases one way or another before the end of Q1 of next year.
Yeah, I think that's almost a certainty.
And so how do we, as smaller companies in specialty coffee, want to respond to that and exist in this environment? So I feel, in my opinion, it's not a question of if, but when should roasters raise price, and how to manage that conversation. And it's a lot more difficult, I think, to do that when there isn't, I mean, consumers are fickle. And when they read a headline that they can associate with a cause, that's a time where they feel they can justify maybe paying a little bit more. But the reality is, the things that cause increases for a business on the back end don't always entirely line up with a narrative that makes sense to consumers. And so largely having a strategy to recognize, do I want to take a view that the costing will go up in general? And this is where I take a step back and say, forget about the market. Let's zoom out beyond a 12 and 18 month window. We have a farm and we work with a lot of farmers, and we know that despite seeing some great efficiencies and innovation that can drive cost down and increase margins in Brazil and some places where there's more opportunity for that, a lot of the world is still continuing to realize increases in input costs, lack of labor. So if costs are going up fundamentally to produce a product, how do we operate and exist and build a business in an industry with that reality? And so to me, that's a more meaningful, rooted logic that should be the narrative. But right now, with the volatility, that's people aren't thinking or talking about that. But that is a constant. Growing coffee was a business that made sense for a lot of farmers around the world 20 years ago and beyond. And that's not the case today, largely, for most small producers in numbers. So there's a lot of other practical costing that I think is completely separate from the market that makes it very, very challenging. But it's I think some additional data that can help build some more predictability.
Yeah, definitely. I mean, you touched a lot of important things there, Edwin. I think the situation of the farmer, the coffee farmer, is a big discussion, and there's a lot to be said there, and whether this is good for the farmer or not, and how to ethically deal with buying coffee and fair pricing. Yeah, those are all big questions. But I think you hit the nail on the head when you said that you can think about this as an opportunity for the roaster, and what systems can they put in place now so that they're prepared in the future. We talked about something. We said something like, what goes up must come down, right? The law of gravity. We know that is the case. The market will fall at some point, whether that's tomorrow or in 2 years. That's the $64,000 question, but that will happen. And so the roaster does want to be in a position to take advantage of that and to recoup some of the maybe some of the losses that they've made at this point. So getting those situations in place will be extremely valuable. Getting your research in place and your intelligence. I advise my clients. I say, you have an edge. You have an advantage as a roaster, which is that you are connected to the market, right? If you're some
Yep.
hedge fund trader in London or New York, you're doing your best to try to understand what's going on as an outsider. But the roaster is an insider. They have connections to people like you, their suppliers, right? To other traders, other roasters, and people in the industry. They have connections to their customers, and that's their edge. That's where they are able to develop their view as an insider. And having that view is going to be absolutely essential to coming up with a plan to manage their price risk. They also have resources like you can subscribe to me on my website, coffeetradingacademy.com. We have a lot of free research that we offer to clients. There's blogs on the market where we talk about current events and more evergreen topics. They could take one of my courses or subscribe to my premium research. These are all ways that they can build that view, right? And even though I'm hawking my own stuff here and telling people they should subscribe to me, what I always tell my clients is you never want to have a guru. You never want to have some person that you're outsourcing your view of the market to, because at the end of the day, it comes down to your own business, and the buck stops with you. And
right.
So, you can't say, well, Edwin told me that the market was going to go down, or Ryan told me that the market was going to go up, right? No one is going to give you any sympathy for that. I will but the market is not going to give you any sympathy for that. You're making payroll isn't going to give you any sympathy for that. It always comes down to you having your own view on the market and acting accordingly. So this catalyst here can be a way for your clients, for my clients, to start building that out and planning it now that they're well aware of what the risks are, and there are opportunities coming soon.
Well, thank you. I just want to repeat that so people can find you at coffeetradingacademy.com. You have some free resources, and then you have some products and services, which I highly recommend for anyone who wants to sharpen and build their view. And we're at exactly 59 minutes here. So I'm thinking I'd like to close us with a statement that you made at the very beginning that resonated, and I think it's very practical. The asset that roasters have is their quality and their relationships. And so it's easy to I think, panic and perhaps lose some rooting in this volatility. But ultimately, I think a large part of the value proposition is whatever quality someone's managing and the relationships that they have, because those are opportunities to, as one builds their view, to involve their customers, whether it's a wholesale account, a cafe, grocery, retail. And I would even challenge people that have retail. In some ways, you have the closest point of access to consumers, to have a voice and an opportunity to, I think, as one builds their view, to be able to share. So thank you so much, Ryan. Really appreciate this, and really appreciate you. And actually, I gotta ask one last question. Maybe you close us with telling us with what's on your wall behind you.
Yeah, I think we might save that for another time. But because I've got so many things on the wall. But the top one there is is the non-commissioned officer sword from the Marine Corps. So that was something we would wear. Not into combat, shockingly, these days. We use rifles now. Yeah, it's one of our ceremonial swords.
Wonderful. Well, thank you much, sir. Much appreciated. Muchas gracias, Oscar, por organizar esto.
Sí, gracias.
Yeah, thank you guys. I appreciate the invite. It was great chatting with both of you, and I'm sure we'll have many more conversations to come.
Excellent. Bueno, feliz día. Good afternoon. Thank you.
Gracias.
Take care.
Bye.